Aaron, I mean, it's pretty evident right now. Yes, the Dow is down marginally, implied at the open, the S&P down as well, but it's Amazon really weighing the most right now, right, sentiment-wise, on the NASDAQ trade overall.
Right, absolutely. I mean, Amazon really always has to beat not just two numbers, but six numbers, right? Because we're always looking at those three major businesses. And if you don't nail it on all six fronts, the top and bottom line of your three major business units, you're going to get hurt because Amazon really is priced for perfection and priced for top growth.
So if that's the case, does that then indicate perhaps that the road ahead is going to be tougher for the entire market trade overall? The fact that this idea that Amazon is perhaps going to mark this notion that we're at peak, at least near term, for the results that we're going to get, the comps seem to be tougher ahead.
Well, I think Amazon and some of the big mega cap technology companies, we've already seen that even if you beat your top and bottom line of your major business units, but there's a margin that came down or something, really people are looking for any reason to push these stocks down. And I really think that comes back to what are the type of estimates that we're looking at that these companies need to beat. And right now, even companies that beat top and bottom line and beat across the board, even on different business units, they're still getting hit pretty hard, particularly those mega caps. And we're looking at a quarter now where 90% of all companies that have reported for the S&P 500 have beat their EPS earnings, and that is an absolute new record. We've never seen anything like that. Admittedly, we're only halfway through. But even out of the past 4 quarters, we've had 4 quarters where we've had beat rates over 80%, average 83, which is about a 10% increase versus the prior 10 years. So I think really it's not just about beating estimates, it's about having a surprise that is much higher and much greater across the board, including guidance in different business units and so on.
I mean, it seems like you're right, because we have a market right now that hit record highs in just yesterday's trade in its session. You mentioned this 90% beat rate halfway through earnings season. It appears as though the market narrative is justifying what's happening with the earnings reporting season and vice versa. So what exactly then takes down this market if everything is going on all cylinders?
So I think the one thing that we might see for taking down the market would be really valuations getting extremely too high. And when you take a look at these new valuations of the S&P 500, we're looking at about 22 times forward earnings. That seems insane. We've never seen those kind of numbers before when you're looking at forward earnings, which means your forward valuations, which means against your earnings estimates. But considering that everybody is putting in these really low numbers and companies are beating them right, left, and center, almost by 100%, that says that actually when we look at forward valuations, we probably should make that E in your PDE a little higher because analysts are putting in such low numbers. And so we could have the market go higher even though we are trading at 22 times versus a previous high of about 19. So in the prior years, normally 19 was your absolute peak and 18 was your high top of the range. But if you look at just how much lower these estimates have become, you could see that it should be a 17% premium going on right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.